Okay, good day to everyone. We pre-recorded the discussion today, so I'm going to, in a moment, play the recording of the discussion, after which we will open for a live Q&A session. So stay with us. Hey everyone, I'm Shira Zimmerman, Investor Relations Lead for the Trendlines Group. With me today are Steve Rhodes and Todd Dollinger, Chairs and Chief Executive Officers of the Trendlines Group, who will present our financial results for the full year earnings of 2021 and thereafter answer questions. To submit a question, use the question and answer function in the call. The financial results for fiscal year 2021 and our press release are also available on the investor page of the Trendlines website. Here is our disclaimer before we begin our discussion today. Please note that this discussion may contain comments that constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results of the business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties and assumptions, including those risk factors discussed in Trendlines offer document dated 16 November 2015 and in the company's filings on the SGX.net, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events, results, and developments could differ materially from those expressed or implied by the forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company or its officers' views as of any subsequent date. The company does not assume any obligation to update any forward-looking statements. Finally, please note all monetary values cited are in US dollars unless otherwise specified. I will now turn the presentation over to Todd Dollinger and Steve Rhodes.
Thanks, Shira. Steve and I are very pleased to report on last year's financials. It was a very good year for the Trendlines Group. In fact, our net income after tax was US $6 million, compared to a net loss in the prior year of $4 million US. Our total cash increased 34.9% to US $14.3 million as of the end of 2021, compared to just $10.6 million at the end of the prior year, 2020. This is a meaningful improvement in our cash position, and the more capital that we have, the more powerful our business model is, and the more we can realize from our portfolio companies at exit. With a portfolio of our size, more capital means that we're able to take greater advantage of the low early stage valuations at which our companies initially raise capital. Additional capital enables us to make more investments when valuations are still low and thereby to improve our returns. Now, despite improvements in our cash position during 2021, the threshold required to exercise our dividend policy was not reached, and accordingly, we've not declared a dividend based on our 2021 results. Now I'm going to hand things over to Steve to discuss the portfolio value and our NAV.
Thanks, Todd. The fair value of our portfolio, not including consolidated companies, was US $83 million at the end of 2021, as compared to $83.7 million at the end of 2020. We hold substantial positions in 13 consolidated Singapore companies for which no value is ascribed here. They're not included in our portfolio value at all. The gain in fair value of investments in portfolio companies was $9.2 million in 2021, compared to a loss in 2020 of $11 million. This is a better than $20 million swing compared to 2020, despite the fact that in 2021, there was a large write-down of our Stematics investment. As a result of the $6 million net profit, our NAV increased to US $102.5 million at the end of 2021, compared to $96.3 million at the end of 2020. Excluding Stematics, which is a passive investment over which we have no control, our NAV has increased by 88% in the last 4 years, an average annual increase of more than 17%. We believe very strongly that this demonstrates the power of our business model and that it's working. Although we continue to believe in the Stematics product and its potential, poor performance has unfortunately forced us to write it down several times. Other than this single passive asset over which we have no control, overall, our portfolio of active companies has performed extremely well. NAV per share increased in 2021 from 16 Singapore cents at the end of 2020 to 17 Singapore cents at the end of 2021. And for our US ADR holders, our NAV per ADR increased from US $6 per ADR to $6.50 at the end of 2021. Despite a slight improvement over 2020, we're still trading at a 38% discount to our NAV. It's noteworthy that a few weeks ago, we published the subscription announcement agreement under which 4 sophisticated investors are buying shares at a significant premium to our share price. Apparently, they believe that our shares are undervalued. I'm going to let Todd talk about some of the achievements of our portfolio companies.
Thanks, Steve. In 2021, we had a record portfolio company exit when we sold 100% of our position in OrthoSpin Limited to a division of Johnson & Johnson. The total sale value was $79.5 million US, and our net proceeds from this were $15.8 million. Our 2 largest exits ever were in 2020 and 2021. This again highlights that our companies are more advanced and they're attracting larger exits. There are several key performance indicators that investors should review when looking at the progress that we're making: profitability, portfolio value, net asset value per share, exits, and the success of portfolio companies in raising follow-on capital. Unlike all the other indicators, this last one really provides the best barometer of the direction of the company's portfolio as it moves into the future. Turning to follow-on raises, we note that in 2021, our company raised a record smashing $77 million in follow-on capital, compared with our previous record of $43 million set just the year before. In addition, 6 portfolio companies each raised more than $4 million US, compared to only 2 that raised more than that amount in 2020. And 2020 was a record, followed by a new record in 2021. Shira, thanks.
Thank you very much. We'll now answer the questions submitted in the Q&A box. Okay, I'm reminding you to please use the Q&A in order to ask questions. At the bottom of your screen, there's a Q&A. Okay.
We note that there are some comments have been made about the quality of the sound. We apologize for that, and we'll certainly look to improve that for our next session. And meanwhile, Shira, we have a question in the Q&A. So let's pick up on a topic that we know is of interest to folks. It's really the impact of COVID upon Trendlines and about our portfolio companies. So I'm going to make an initial comment, and I think Steve's going to want to add to that as well. Of course, we have been impacted by the virus. It's impacted our operations in China, in Singapore, and in Israel. Most profoundly, we see this in the impact on our companies that are really just at the beginning stages of going to market. This is true both on the medical side, where companies that were beginning sales could not go into the hospitals to meet with doctors, could not begin to do procedures in the hospitals. And we saw a similar situation with early sales for our agri-food companies too.
The pandemic in many ways has actually driven on the agri-food side even greater interest in investing, and has pushed investors to look at the agri-food investing even more than before. The pandemic, as I think everyone knows, had a big impact on supply chain issues. And in many countries, particularly smaller countries like Singapore, Israel, the UAE, and others, it increased concerns about food security. That concern about food security in turn led to people looking for solutions that included indoor agriculture, intensive agriculture, synthetic biology to produce foods without agriculture or with limited agriculture, reduced reliance on labor, which was disrupted dramatically. So we've seen a big increase in interest in investing in the agri-food tech side. And I think that for Trendlines, although it may not be good for the world, it's been good for our portfolio companies. As Todd said, many of our companies had a hard time getting to market during the 2021 period as a result of disruptions in flight, international travel, and the like. We've also seen some supply chain issues in terms of producing product, but overall, we've come through it very strong, and it has had very little impact on Trendlines overall. In fact, we were very proud of the fact that at the end of 2021, we were awarded a Resilience Award by a group in Singapore led by the Singapore Institute of Directors, recognizing our response as a corporation to the pandemic and the resilience of our staff and our companies in terms of being able to adapt to the new world that we find ourselves in.
As commented on, one of the restrictions that we suffered from during the pandemic was a loss of the ability to travel in any substantive way. We see this changing now. We began traveling again really by the middle of last year, but in a much more limited way than had been done previously. Travel to meet with our strategic partners, travel to meet with our portfolio companies, potential partners and customers, and simply to attend conferences in the industries in which we operate. We seem to be at a time of great change on this right now, and we take a look just at March and how much travel there will be. We'll be attending several medical conferences. We had staff at a conference in Dubai just last week, and we're going to see more travel, the pace of our contacts with strategic partners accelerating.
Okay, we've had one question here regarding the subscription agreement that we published a couple of weeks ago. People are interested in understanding why, if we had a good year with a good cash position finishing off with 2021, why do we feel the need to go out and bring on new investors and more money into the company?
This actually we touched on in our presentation, and it's an important question. As everyone knows, we are company creation investors, early stage investors. This allows us to really capture meaningful percentages, meaningful holdings in our portfolio companies, and to do so at low valuations. And having more capital available for us allows us to continue to do that and to continue to invest aggressively in companies at low valuations in their early stages and position ourselves to bring in more investors later and not be terribly diluted through that process.
We also, as a matter of policy, look to have at least 2 to 3 years of cash on hand at any given time in the company, so as to be able to keep our eyes on the ball of what we're doing in the company and not just to be looking at where cash is coming from. And so we need to be prudent and cautious and make sure that we always have sufficient cash. We know that in the past we've had questions from investors about our cash position and concerns about it, given our lumpy ability to bring in cash from exits and the fact that it's not always predictable. So it was important for us to maintain that cushion.
And good to note is that the investors that join us in this round that are investing some $15 million with us, these are very experienced professional investors who know our portfolio well. They spent time getting to know us, and they're choosing to invest with us number one. And number two, they're choosing to invest with us at a price well above the market. Clearly, they see our stock as undervalued. And we appreciate their support. We appreciate their conviction that Trendlines is a good investment.
Shira, since folks commented that there was a problem with the sound, and as Todd said, we will look to improve that or solve the problem in the future. Maybe I'll just quickly run through in a bulleted way the highlights of the results to make sure that everyone was able to hear them. 2021, our net income was $6 million US compared to a loss of $4 million in 2020. Our total cash increased 35%, 34.9% to $14.3 million compared to 10.6 at the end of 2020. The gain in fair value of our portfolio companies was $9.2 million compared to an $11 million loss in 2020. NAV increased to $102 million, 102.5 from 396.3 at the end of the year. We also noted that over the last 4 years, excluding schematics, our NAV has increased at a rate of over 17% a year on average, a total increase of 88% over the last 4 years. I think it's a great year for us with a lot to be proud of. Our portfolio companies raised a total of $77 million in follow-on capital. And I think that positions them as well as us for good things looking forward.
Right. And with that, we want to thank our hardworking, dedicated staff who brought us to this position, a position that we're proud to be in today in terms of the success of our portfolio companies, and that we look forward with continued hard work to bring more companies to strong and profitable exits and to helping us achieve our mission to improve the human condition.
We'd also like to thank our shareholders for sticking with us. We know it's been a long and bumpy ride, but we think that the company today is in a position that it's never been in before in terms of the strength of our portfolio as reflected by the growth that we've seen consistently over the years and the large raises the companies have done. We're looking forward to good things.
Okay, we have an extra question here. Why did short-term bank deposits increase when they were only about 100K in the previous year?
Okay, it's a good question. It's very technical. Back about a year ago, we did some hedging. We entered into to protect our cash position and to lock in some interest rates. We during the course of the year, that required us to lock up a deposit for a 12-month period. And at some point during the year, we wanted to draw down on that deposit, but we couldn't break the deposit. So instead, we simply took a loan at the bank against that deposit. If you look at the short-term deposit liabilities, you'll see that $4 million liability, short-term liability. But if you look on the asset side, you'll also see a bank deposit in a similar amount. Those two things will offset each other and not appear in future financial statements. Thanks for that question.
Does that wrap us up for today, Cheryl?
Yeah, I think that we can wrap up for today and remind anyone who thinks of a question later on that they can always message us at investors@trendlines.com or shira@trendlines.com. And we want to thank you all for joining the call this morning. Anyone who had problems with the sound can also ask us to send them the link to the recording, and we'll be happy to do so. Thank you all and have a good day.
Thank you for joining us.
Thank you. Bye-bye.